Here's the basic accounting equation expanded to show the two key equity financing sources, capital contributions and retained earnings. Whenever any equity account is credited, meaning a right-hand entry in the equity account, total equity up here will increase. So that's what I've shown. Whether you credit revenues or credit expenses or credit dividends, any of these credits, they will flow up and wind up increasing the total equity of the business. Whenever any equity account is debited, meaning a left-handed entry, total equity will decrease. So whether you debit revenues or debit expenses or debit dividends, the impact, if you follow the arrows through, will wind up decreasing equity. Now where this gets a little confusing is if you debit an expense, that means you have more expenses, but the impact will be you have less net income, less retained earnings, less equity. If you debit revenues, that means you have less revenue, which means you have less net income, less retained earnings, less equity. Example, when expenses are debited, what happens to total equity? Hint, follow the arrows. Expenses would increase. Net income would decrease. Retained earnings would decrease, and total equity would decrease. Example, what if revenues were credited? Revenues would increase, net income would increase, retained earnings would increase, and total equity would increase. If you were to credit an expense, that would reduce expenses. By reducing expenses, your net income will increase, retained earnings will increase, equity will increase. It is essential that you learn this expanded part of the accounting equation so that you know which accounts are increased with debits, such as expenses and dividends, and which accounts are decreased with debits, such as revenues, net income, retained earnings. Debits on the left, credits on the right, debits on the left, credits on the right.